when you open up your laptop and ask an artificial intelligence a question, it just, it feels entirely
Oh,
weightless.
absolutely. Like it's just pure code floating around in the cloud somewhere.
Exactly. You get an answer 3 seconds later and you don't even think about it.
Yeah.
But answering that single question requires moving, hundreds of tons of steel, cooling systems, and physical servers into these massive concrete buildings all over the world.
Yeah, it takes an unbelievable amount of brute physical force to maintain that weightless digital illusion.
Right. So today, we are taking you under the hood of the heavy industrial tool industry. We really want to look at the physical reality that is underpinning the global economy right now.
It is a great topic. Looking at a legacy company in this space provides just a fascinating diagnostic for the broader economy.
And to do that, we are diving into Enerpac Tool Group's Q3 fiscal 2026 earnings. These were literally just released today, July 8, 2026.
Yeah, and they released them alongside a massive $500 million acquisition announcement.
Which we will definitely get into. So our entire roadmap for this discussion is grounded in Enerpac's official Q3 earnings presentation and their press release.
Right, because they manufacture the actual hydraulic tools and heavy lifting tech that physically construct our modern infrastructure.
Exactly. And through these sources, we get an unvarnished look at how geopolitical tension alters supply chains, how companies maneuver through weird regulatory surprises, and the sheer muscle required to build out the tech sector. Okay. Let's unpack this.
Sounds good. So the top-line numbers offer a very clear snapshot of where the industrial hardware market sits as we head into the back half of 2026.
Right. Let's start with those top-line numbers. For their third quarter, Enerpac reported net sales of $168 million.
Which is a solid 6% year-over-year increase.
Yeah, and even if we look at it organically, meaning we strip out all the noise of currency exchange rates and just look purely at their baseline operations, they still posted a 3% organic growth.
Right. 3% organic growth is totally respectable, and their adjusted earnings per share came in at 60 cents.
So on the surface, those top-level figures look really healthy. But, the sources reveal this really stark divide right down the middle of their industrial tools and services segment.
Yeah, the split there is wild.
It really is. The hardware side, the product side, grew 5% organically compared to last year. I mean, they're shipping a lot of physical tools.
Right, the tools are flying off the shelves, but then you look at the service side, the revenue from maintaining and repairing that equipment out in the field, and that dropped 8% organically year over year.
8% drop. That's a huge contrast.
Now, they did note a 17% sequential improvement in service from the previous quarter, which, indicates the bleeding might be slowing down a bit.
Sure, but a year-over-year drop of that size is still substantial. To picture this dynamic, I like to imagine a commercial vehicle dealership.
Okay, I like where this is going.
Right, so the showroom in the front is just moving heavy-duty trucks off the lot faster than ever. Sales are booming. But the repair shop in the back is just unnervingly quiet.
Oh, that's a perfect analogy. You have high product demand, but very low service engagement.
Exactly. So why is the repair shop so quiet?
Well, what's fascinating here is how a completely unrelated regulatory decision can suddenly alter the financial picture of a quarter. It kind of masks some of that operational quietness in the service bay.
Oh, right, the regulatory windfall. You mentioned the 60 cents adjusted earnings per share earlier.
Right. So 8 cents of that 60 cents actually came from this unexpected windfall tied to something called EPA tariffs.
Yeah, I saw that acronym in the presentation. Walk us through that, because how does a tariff situation turn into a random earnings boost?
So IEPA stands for the International Emergency Economic Powers Act. Basically, the executive branch had previously used this act to impose some specific tariffs on imported goods.
Okay, so Enerpac had to pay these extra taxes on stuff they were bringing in.
Exactly. However, earlier in 2026, the Supreme Court actually invalidated those specific tariffs.
Wow, so because Enerpac had already paid them, the court's ruling meant they were suddenly owed a refund.
Bingo. That single non-operational event provided that 8-cent per share bump. And it also artificially inflated Enerpac's gross margin for the quarter by a massive 260 basis points.
Okay, let's translate basis points for the listener, just so we understand the actual scale of that bump.
Sure, yeah. A basis point is just 1/100th of a percentage point. It's a term finance folks use to remove the ambiguity of talking about, percentages of percentages.
Right. It keeps the math clear.
Exactly. So an increase of 260 basis points simply means an increase of 2.6 percentage points.
Got it. And that refund pushed Enerpac's overall gross margin up to 53% for the quarter.
Which is huge.
Yeah, a 53% gross margin for a company forging heavy hydraulic steel tools is incredibly high. I mean, it flirts with the margins you'd expect from software companies, not a metal bender.
Oh, absolutely.
But this creates a really profound question about the underlying health of the business. We have physical products selling reliably and margins looking exceptionally robust thanks to a Supreme Court ruling.
But that service side is still struggling year over year.
Yes. Why is the repair shop in the back of our metaphorical dealership still so quiet?
Well, to answer that, we have to zoom out from just domestic sales figures and look at global macroeconomics.
Okay, so it's a global issue.
Yeah, the slump in the service side doesn't necessarily mean Enerpac's tools are breaking less often or that clients don't want their expertise anymore. The sources point directly to global instability.
Right, specifically the armed conflict in the Middle East.
Yes. The earnings presentation estimates that the Middle East conflict created at least a $3 million revenue hit to their Q3 service revenues alone.
Which is significant. But I want to actively challenge the mechanics of that just to make sure we are crystal clear for the listener.
Sure, go for it.
How does a regional physical conflict specifically halt industrial tool servicing? Like, is this a supply chain freeze? Are replacement parts just stuck on a cargo ship unable to navigate the Red Sea? Or is this more about the human beings?
It is predominantly about human capital. I mean, industrial servicing isn't something you can just do remotely over a Zoom call.
Right, you can't just log in and fix a physical hydraulic pump.
Exactly. It requires sending highly specialized technicians to these complex, critical infrastructure sites like power generation facilities, petrochemical plants, offshore oil rigs.
Oh, wow. Yeah, those are sensitive areas.
And when a geographical region experiences severe volatility or armed conflict, the risk profile for deploying human personnel changes drastically. Insurance premiums for your workers skyrocket, or sometimes coverage is just pulled entirely.
So you physically cannot send your engineers into a war zone to calibrate a pump. It's just not safe.
Precisely. The project just gets paused. The routine maintenance is deferred until the environment stabilizes.
Makes total sense.
I mean, shipping disruptions certainly play a secondary role in moving replacement parts, but the human element of the service business is just incredibly sensitive to geopolitical fluidity.
Right. And the objective business impact, as Enerpac outlines in their presentation, is that physical industrial work in the region simply halts.
Exactly. It just stops.
And the forward-looking statements in the sources are quite sobering on this front.
Yeah.
I mean, they are not projecting some sudden diplomatic resolution that instantly reactivates all their service contracts.
No, not at all, because the situation remains fluid, which is the word they use. They expect minimal service recovery in the Middle East for their fourth quarter.
So they're basically pushing any anticipated rebound for that specific revenue stream all the way out into fiscal 2027.
Yeah. And to contextualize that $3 million localized hit, Enerpac calculates that this single geopolitical issue dragged down their overall company-wide organic growth by about 2% for the quarter.
Wow. So if the geopolitical landscape were perfectly stable, that 3% organic growth we talked about earlier could have been 5%.
Exactly.
It perfectly illustrates how tethered a 116-year-old Wisconsin-based manufacturer is to global affairs.
Right. And the thing is, if organic growth in a specific division is paralyzed by external macro headwinds, a company generating strong cash flow cannot simply wait around for the world to stabilize.
Right, they have to take action.
Yeah, they have to basically manufacture their own growth by acquiring it. They deploy their capital into markets they can actually control.
And here's where it gets really interesting. Enerpac announced a definitive agreement to acquire the Specialized Fabrication Equipment Group, which we will just call SFE Group, for $472 million in cash.
Nearly $500 million.
Yeah, for a company most people have never even heard of. So break down SFE Group for us. Who are they and why on earth are they worth that much money?
Well, SFE Group was founded back in 1936. Today, they operate with roughly 350 employees across this really dense portfolio of 12 distinct brands.
And the presentation highlights names like Climax, B&B Sumner, and Axair, right?
Yep, those are the big ones. And their entire business model is built around dominating these highly technical, incredibly niche fields. We're talking pipe fabrication, portable machining, and orbital welding.
Okay, those terms sound very impressive, but let's translate them into a tangible scenario for the listener.
Sure.
Think about critical infrastructure that relies on heavy piping, like a nuclear submarine or a sprawling chemical refinery or even a pharmaceutical plant.
Right.
If a massive pipe deep in the belly of a submarine needs to be cut, beveled, and re-welded. You cannot simply unbolt it, load it onto a truck, and ship it back to a factory to fix.
No, you have to bring the factory to the submarine.
Exactly. I like to think of SFE Group as the ultimate heavy-duty Swiss Army knife for critical industries. They provide the tools that allow engineers to perform factory-grade machining out in the field.
Right. Instead of taking the patient to the operating room, SFE's tools bring the operating room directly to the patient.
That's a great way to put it. They physically latch onto the existing infrastructure and perform these microscopic cuts and welds right there on the job site.
And orbital welding is a perfect example of this extreme
I
specialization.
was going to ask about that. What exactly is orbital welding?
Well, in industries like biopharma, for instance, liquids flow through miles and miles of stainless steel piping. Now, if a weld joining two of those pipes is even slightly uneven on the inside, it creates a tiny microscopic ridge.
And I imagine that's a problem.
A huge problem, because bacteria can pool and multiply in that tiny ridge, contaminating the entire production line.
Oh, wow. So it has to be literally flawless.
Right. So orbital welding uses these automated tools that rotate 360 degrees around a stationary pipe, creating a perfectly smooth, uniform weld every single time. It completely removes human error from these critical connections.
Incredible. So the sources make a really compelling case for why Enerpac wants to own this capability.
Yeah, if we connect this to the bigger picture, the strategic rationale for a $472 million purchase really crystallizes. Enerpac is buying a massive expansion of their total addressable market, or SAM.
And according to the presentation, SFE expands Enerpac's SAM by roughly $1 billion.
Yep, bringing their overall addressable market to $5.5 billion.
So they're essentially just buying access to a much larger pool of potential customers.
That's part of it, sure. But the presentation also heavily emphasizes the types of customers SFE brings to the table.
Right, because Enerpac's core business relies pretty heavily on general construction and traditional industrial markets, right?
Exactly. And SFE diversifies their portfolio into these high-growth, high-margin verticals that are generally more resistant to general economic downturns.
Like aerospace, defense, semiconductor manufacturing, and those biopharma pipelines we just discussed.
Yes. And beyond just the industry diversification, it also shifts their geographic footprint significantly.
Oh, true. The presentation noted that 72% of SHE's revenue is generated in the Americas.
Right. Think about that timing. At a time when Enerpac is watching their European and Middle Eastern service revenues stagnate due to the geopolitical conflicts we just covered, they are purchasing this cash-generating engine that is deeply entrenched in the American industrial base.
It's a very calculated hedge. Now, Enerpac struck this deal at a valuation of 10.6 times trailing adjusted EBITDA. But the presentation notes they expect to bring that multiple down to 9.5 times after realizing 3 years of synergies.
Right, the classic synergy projection.
Yeah, let's decode trailing adjusted EBITDA for the listener real quick, because it is basically the fundamental metric used to price acquisitions like this.
Sure, so EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's a mouthful.
It is, yeah. But simply put, it's a metric used to strip away all the weird accounting variables and look strictly at a company's raw cash-generating power from its core operations.
Okay, and what about the trailing adjusted part?
Trailing simply means looking backward at the past 12 months of actual performance rather than guessing or projecting the future.
Makes sense.
And adjusted means they removed any weird one-time financial events like, say, selling a warehouse or paying a massive legal settlement to find the true, normal operational baseline.
Got it. So Enerpac looked at SFE's pure baseline cash generation over the last year and paid 10.6 times that amount in cash to own the company outright.
Yes.
And they expect to reduce that effective cost to 9.5 times by finding these synergies, which, let's be honest, usually translates to combining sales teams, eliminating duplicate administrative software, and running SFE's tools through Enerpac's established global distribution network.
Right. Consolidating operations to save money. But, while SFE Group represents this massive bet on the future of pipe fabrication and defense infrastructure, the earnings report also reveals that Enerpac's legacy product line is surging right now.
Yeah, they're thriving by supporting the infrastructure of the present.
Exactly.
And this brings us full circle to the whole paradox of the digital economy we started with. We think of artificial intelligence and the cloud as entirely weightless, but building the physical data centers to house them requires colossal physical effort.
Absolutely massive effort.
Yep. The sources highlight that Enerpac has launched this targeted marketing campaign specifically for data center builds. And the results are already materializing.
Yeah, I saw that. A new end user recently purchased 3 SL200 hydraulic gantries exclusively for data center projects.
So to understand the true significance of that, we have to look at what heavy lifting technology, or HLT, actually does.
Yeah.
What is a hydraulic gantry?
So a hydraulic gantry like the SL200 is a structural lifting system. It's used when you need to move hundreds of tons, but you lack the overhead space to bring in a traditional giant crane.
Because you're usually inside a building.
Right. Imagine trying to install a 200-ton backup generator inside a concrete building that already has a finished roof. You can't drop it in from above.
Right.
So you build this steel gantry framework around the generator and use high-pressure hydraulics to push the weight up from underneath and then slide it into position.
That's wild. So Enerpac is not just marketing old tools to new tech companies. They are engineering specific solutions for this AI boom.
Yeah.
I mean, they launched 8 new products in fiscal 2026 alone.
Yeah, their innovation engine is running hot.
And 2 of them stand out in the sources as just perfectly tailored for modern infrastructure demands. First, the battery-powered dual machine skate set.
Oh, these are fascinating. Machine skates are essentially incredibly durable, very low-profile crawlers.
Like little flatbed robots.
Kind of, yeah. In the context of a data center, tech companies are increasingly using prefabricated server modules.
Right, these massive, incredibly dense steel racks preloaded with servers.
Exactly. And instead of using a forklift, which requires wide aisles and risks tipping this incredibly expensive equipment over, you just slide these battery-powered skates under the module.
Oh, that's smart.
Yeah, and then a single operator can use a wireless remote control to drive thousands of pounds of delicate computing equipment smoothly into a very tight space.
It's brilliant. And the second product they highlight is the LU Series lightweight torque wrench pump. Now, when you are constructing the steel skeleton of a sprawling data center facility, workers are driving and tightening thousands of structural bolts every single day.
Right, and a standard hydraulic pump used to power those torque wrenches is traditionally very heavy and cumbersome.
Yeah, dragging it across scaffolding all day long causes immense physical fatigue.
It's grueling work. So by designing a high-frequency, lightweight alternative, Enerpac directly addresses the repetitive physical stress placed on the human workers building this infrastructure.
It's amazing that tech sector's insatiable demand for physical server space is providing this huge, tangible tailwind for a 116-year-old heavy lifting company.
Who would have thought?
Right. So what does this all actually mean? We have a narrative full of competing forces here. I mean, Enerpac has solid organic product growth and a lucrative tariff refund, sure.
But they are fighting geopolitical headwinds that are actively dragging down their service sector.
Exactly. And simultaneously, they are riding a surge in demand from data center construction. And they just committed $472 million in cash to acquire SFE Group.
It's a lot of moving parts.
It is. The pragmatic question here is, how does Enerpac actually pay for this acquisition and finish out the year without completely overextending themselves?
Well, the financial mechanics outlined in the presentation show a fundamental shift in their balance sheet. To fund the $472 million SFE purchase, Enerpac is significantly expanding its revolving credit facility.
Right, taking it from $400 million up to $625 million.
Yes. They are borrowing heavily to make this happen.
They are.
And consequently, their leverage, specifically their net debt to adjusted EBITDA ratio, will jump to approximately 2.8 times at the closing of the deal.
Let's give some context for that, because currently their net debt to adjusted EBITDA sits at a remarkably low 0.5 times.
Right. They were running very lean on debt.
Yeah, going from 0.5 to 2.8 times leverage is it's similar to having almost zero credit card debt and then suddenly maxing out a massive line of credit to buy a second home.
That's a great comparison.
It is a substantial increase in their risk profile.
The risk profile absolutely changes, but to be fair, their management team has communicated an aggressive deleveraging plan.
Okay, so they aren't just sitting on the debt.
No, their stated target is to rapidly pay that debt down to a ratio of 1.5 to 2.5 times by the end of the first year post-acquisition.
But how do they plan to pay down that metaphorical mortgage so quickly, especially while absorbing a new company and dealing with a service slump in the Middle East?
This is where we have to examine their free cash flow.
Ah, cash is king.
Always. Free cash flow is the money a company generates from its normal operations, minus the capital expenditures required to simply maintain those operations.
So, like buying new factory equipment or upgrading software, you subtract that out.
Right. It is the true liquid cash left over at the end of the day. And despite the macro challenges, Enerpac's year-to-date free cash flow currently sits at $60 million.
Which, if I remember the chart correctly, is actually $20 million higher than the same period last year.
Exactly. Having that robust, guaranteed paycheck coming in every month gives them the financial ammunition to aggressively service and pay down that new acquisition debt.
But they did have to adjust their expectations for the remainder of fiscal 2026 to account for the current landscape, didn't they?
They did. They narrowed their full-year guidance to project net sales between $635 million and $645 million, which represents a modest 1% to 2% organic growth for the year.
Okay.
They also expect adjusted EBITDA to land between $151 million and $156 million. But most importantly, for their debt repayment plan, they project generating between $100 million and $110 million in full-year free cash flow.
Wow. Over $100 million in free cash flow provides a very comfortable safety net.
It does.
But, purchasing a company with a strong balance sheet is entirely different from successfully running that company.
Right, and this raises an important question regarding their execution over the next 12 to 36 months.
Yeah.
Enerpac is not absorbing a single unified brand here. They are taking on SFE's 12 distinct brands and their 350 employees.
Which sounds like a logistical nightmare.
Well, the presentation estimates Enerpac will incur $10 million to $14 million just in integration costs.
Ouch.
Yeah. So the true measure of this acquisition success will be whether they can seamlessly merge those brands into their distribution network and actually extract those $4 million to $6 million in annual cost synergies by year 3.
And they have to execute this highly complex integration while continuing to navigate a fluid global environment that is, as we discussed, currently suppressing a key piece of their core service business.
Right. The management team must ensure that the gravitational pull of integrating SFE Group doesn't completely distract them from capitalizing on the heavy lifting demands of the ongoing data center boom.
It's a tricky balancing act.
Very tricky.
Well, we started this deep dive exploring what a legacy industrial tool maker could tell us about the global economy in 2026.
And we covered a lot of ground.
We really did. We uncovered how regulatory shifts can artificially boost quarterly margins and how geopolitical friction halfway across the world physically paralyzes industrial maintenance.
Yeah, the human capital element.
Right. We explored how a company facing stagnant regional growth deploys its capital to acquire high-growth domestic verticals like biopharma and defense. And beneath it all, we found a company building the literal hydraulic muscle required to prop up the artificial intelligence revolution.
It's been a fascinating look under the hood.
It really has. I want to leave you with a final thought to ponder as you go about your day.
Let's hear it.
As our society becomes increasingly fixated on the weightless digital realm, we're all obsessed with software, algorithms, and the ever-expanding cloud, we paradoxically become entirely dependent on the heaviest, most rugged industrial tools on Earth to sustain it.
So true.
It begs a fascinating question for the future. Will the ultimate bottleneck for the next great leap in digital technology not be our ability to write better code, but rather our physical capacity to forge, machine, and lift the thousands of tons of steel required to house it?
The physical world always bats last.
It really does. Thank you for joining us on this deep dive. We will see you next time.